I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show. And today we're going to go over a new product that's been basically launched by a lender. And there's not many programs like this. And it's a 2-1 buy down, and it is lender paid. What does that mean?
Yeah, lender paid. There's different options. You can have borrower paid. You can have seller paid. You can have lender paid. So this one is actually coming from the lender itself.
That's right. So most real estate agents, if you're working with buyers, if you're looking at a 2-1 buy down, and so again, most of the ones that have been out there for years, the 2-1 buy down requires the seller to pay for your buy down, the cost to buy down the interest rate. And this one, it is paid for by the lender. But the mechanics are exactly the same in how the buy down works.
So it's very simple. So on a typical mortgage, if you were to do a 30-year loan, you would have 30 years at the same interest rate. That's a fixed mortgage. In this case, you still have a 30-year fixed mortgage, but for the first year, it's 2% lower than what it should be. And then for the second year, it's 1% lower than what it should be. And then starting on your third year and beyond, it goes back to what the initial interest rate should have been. So it's giving you a temporary relief, which is real relief. I mean, look at these rates.
That's right. And so this is an example of a $250,000 loan. Now, imagine, again, this is just for this example, a 6.99% interest rate. The 2-1 buy down, the first 12 months is 4.99%. The second year is 5.99. The total savings is $5,824. And again, the lender is paying for this. The interest rate is slightly higher than if you did not do a buy down, it's slightly higher. But again, for buyers looking for that relief in their mortgage payment, this is a really, really good program. And it's also like, why not just do a standard 2-1 buy down? The reason why it may not work to do a standard 2-1 buy down is because the seller may not be willing to do or add anything extra for the buy down.
And for people that haven't purchased a home before, they may say, well, whether the lender pays for it or the seller pays for it, who really cares? Well, ask the seller that question, because they really do care. If they have two offers they're looking at, and one offer doesn't have any ask for seller credit compared to your offer with seller credit, I guarantee you they won't look at those offers equally.
So this is going to give you options. We can do a standard 2-1 buy down if the seller pays for it, or another version that the lender pays for it. So we can look at all these options together. And I think there are important details to go over, though. This program is again, it's paid by the lender, not the seller. It has reduced mortgage insurance because it is a part of a conventional loan, part of the Fannie Mae and Freddie Mac Home Ready and Home Possible programs. The buyer can put a minimum or has to put a minimum of 3% down, which is very low down payment. Very good.
Yeah, 3%. That's lower than FHA.
There is a maximum loan amount of $350,000. So that's the loan amount. So it's really going to be geared a lot towards either first-time home buyers or lower priced homes, especially here in Maricopa County. And there are buyer income limits. You cannot make over 80%. You heard that right. You cannot make as your income more than 80% of the area median income. And for most of Arizona, that would be $81,000.
So for those that don't qualify for this loan, we end up saying, hey, we have good news and we have bad news. The good news is you make more money than the person that would qualify for this loan. The bad news is that you don't qualify for this loan. But I ultimately would say our goal, as humans, in the workforce, is to make as much money as you can. So again, I would not be depressed if you do not qualify for this loan. It means you are making more than 80% of the area median income. Yeah. And also too, to help you solve for whether or not this loan program works, whether you're thinking about a niece or a nephew, or frankly, even a parent, it really is these two things. One is loan amount. Loan amount at $350. A lot of loans in Arizona are creeping up above that just because of these median home prices. And then two, that area median income. Ask those questions of your loved ones or friends that are asking about this program first, because that will tell you and save you a lot of time.
And if you do make over $81,000 or you're looking for a loan amount far above $350,000, the 2-1 buy down is available in the standard version, which allows, but it requires the seller to pay for it. So there is a way to actually have relief in this, in your mortgage payments. So reach out to the Mortgage Brothers. If you have any questions, be sure to subscribe, comment, and like if you like what we're doing here, and we will give you future updates here soon.
All right. Hey, thanks, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.